Hello, my friends. This video is created to answer a few questions one of my clients has sent to me, and I figure it was for the sake of other people who maybe have similar questions as well. I made this video specifically to help you as well. Now, most of you have noticed that the Bank of Canada has lowered the benchmark rate from 5.34 down to 5.19, which may sound significant, but in reality, it really isn't. I was checking on $500,000 mortgage deal with an income of about $100,000 for family income, and negligible differences really. It only increased the loan amount by, I believe, like $9,000. So it's not huge. Now, however, if somebody is on the borderline, that benchmark rate drop has actually helped them qualify from being a decline versus an approval now, which is great. Now, how many people is going to be affected? I'd probably say anecdotal evidence has shown that only maybe less than a handful has been in the whole entire community that I've watched and read the comments that been impacted, right? So it's not a huge thing that the government has put out there in the media. It seems significant, but in reality, it isn't, right? So great. They've actually finally lowered, it took them years to do that, but I believe it's too little too late. And I'm sure a lot of my residential mortgage brokers have echoed the same thing. My colleagues have always mentioned the same things, like, ooh, big deal. Exactly. So anyway, move on. The other question that my client has asked me about is that, my current lender has came to me and said that if we lock it in, we'll give you an X rate right now. Currently, the lender gave them 2.89% if they locked in for 5 years. They're currently in a variable rate mortgage, and the interest rate has climbed over the years because the prime rate has gone up. And they're looking at about 3.04% right now because of the current financing that they took at that time, right? I believe this must have been a rental property. Anyhow, regardless, if they took the fixed amount of 2.89, they would save some money. How much money? Well, significant. Could be, potentially, over the years, yes, and over 5 years, quite a bit of money. Before doing that, though, I strongly suggest to look at what is the long-term strategy of this property. Is it going to be held indefinitely for the next 3, 4, 5 years? If it is, then sure, lock it in, right? You won't impact it by having a huge, I would say, penalty if the event comes, you want to sell it. And in this scenario, if you're going to hold it for long term, then probably it's moot point, right? Caution though, once you lock it in though, there's always going to be a penalty. If the interest rates rise, the penalty will probably be very insignificant because they're going to probably go down to like 3 months interest payment because they probably want you to pivot the money so that they can lend to somebody else at a higher rate. So in reality, it's actually helpful for you in this scenario. And because you took it from a credit union, so the credit unions are more favorable when it comes to, especially the one that you got it from. They're more nice. They're more fair when it comes to penalty, and they don't have the high posted rate that the banks, the big FI, tend to have, which is quite a bit higher, right? Penalties are much more favorable when it comes to credit unions, especially this one anyway. On the flip side is that if you were to lock it in, right? Yes, the penalty is there, but you're probably gambling in the event that the interest rate is going to go up in the future. But if it does drop, the penalty will be much higher. It's significantly higher, more than 3 months interest payment. Just to warn you, right? If you look at this though, in the long run, don't worry about it so much. Lock it in, great, that's fine. The other question you've asked me is that 2.89, is that a good deal? Well, if you search in the internet, you probably see a lot of other lenders out there are less. 2.79, even to 2.72% interest rate. So the rates are not as good as they could have offered. The competition has actually lowered it now to about 2.79, and I can see it's coming down even with some other lenders to 2.72 right now, right? So if you hold out, you might get a little bit lower, but I don't think it's gonna be much. Even if I calculate based on 2.79% interest rate, the 2.79% versus 3.04, you're talking probably about $70 for every 100,000. So Is it significant to make the change? Could be. $70 is nothing laughable for $100,000. If you got $300,000, that's about $210 per month, right? So $210 a month, sure, that's like $2,400 or more, over $2,400 in the whole year, right? So it is significant savings. Over 5 years, that's like 10 grand, right? Sure, that's not a chunk change now. On the other side, if it's $100,000, then it might not be significant enough for you to make all that nuisance of a change, right? Yes, I strongly advise in perhaps renegotiating with the current lender, and perhaps push them that you may consider moving elsewhere, so that they can say, oh, well, we want you to stay, right? Maybe they can sharpen the pencil a little bit more, per se. And you mentioned that other lenders such as HSBC having a very, very low rate. Now, bear in mind, they have low rates, but how much are you really saving, right? If it's significant enough to calculate that there's going to be dramatic savings, great. Because chances are they may not cover legal fees, they may not cover appraisal fee, which could be added into your expense, right? Calculation. Keep that in mind. If that's the case and you're only saving, sure, $2,000 over $2,500 over 5 years, it's not really significant to make that nuisance of a change. Who knows? Maybe it is, maybe it doesn't. If it's a big deal to you, then go ahead, make a change, right? But for me, yeah, not worth about the hassle of going through the whole entire paperwork process and the customer service with certain lenders. I love HSBC when I deal with them in one of my mortgage as well, and I have other products with them too. I don't need their customer service, but from the experience that a lot of my clients have given me feedback that customer service isn't as good as their previous bank, which is like credit union, for instance, where they're more hands-on, they go out of the way, they help you. Banks that are really low price, low bond, no frills, like for this, for example here, is they really don't have the capacity to get things done faster, to give you top-notch service that you expect from these lenders, right? That you're accustomed to in the credit union, because they're smaller. So keep that in mind. How much is that worth to you? And also the location. Are they available wherever you're located? Is it going to be a nuisance for you to drive like 45 minutes to an hour to get to the nearest HSBC bank or whoever the other bank could be, right? So don't always look at cheaper rates as a significant factor. Calculate everything in together to make sure that it's worth your while, right? If it's going to only save you like $1,500, $2,000, I don't know. You keep that in mind. Is it worth that hassle? Is it worth the headache down the road? Could be, could not be. Now, when you do switch over to a fixed rate at the big FI, they use posted rate to calculate penalties. So bear that in mind, right? They use a higher number. It could be 5.34, it could be 5.19, whatever the amount is when you lock it in. They use posted rate at the time that you lock in, not the discounted rate. Okay, capiche? All right. So, win one, lose the other. All right. If it is for 5 years straight and you adamant about not selling that property no matter what happens, all right, Hail Mary, then sure, it's a great deal to lock it in and keep the low interest rate now. Would it go down lower? You asked me, would it go down lower? Anything below 3% is great right now. If it gets any lower, even if it goes down to now 10 basis point, you only save yourself maybe an extra $5, $10 a month. I don't think that's going to be much at all, right? If you look at the bond rate on Canada bonds, 5-year yield, it has gone down a lot. From at one time it was 1.75, 1.8, and now it's gone down to below 1.5, like 1.47 or something, and it's still coming down a little bit more. Now, the spread that they typically have for profit that the banks have the mortgage is very small. You're talking about 1.25% to 2%. I believe between 1.4 and 1.5 is what they aim at. So if the current bond rate is 1.4, how much low can they drop? They want 1.4 plus 1.4, right? 1.4 is the current bond rate, and if they want the profit margin of 1.4, that's 2.8. So they really can't push any further down without affecting their profit margin. Yeah, it's a loss leader. So mortgages is not a big thing for banks anyway. It's a loss leader for them, right? It's the other products that they fish you in so that you get not just mortgage, but you get the credit cards with them. That's where they make the money, really, right? You get some RSP investment with them, the low interest rate, GIC, right? They lock in your money, they leverage your money. That's how they make money. It's not the mortgage, my friend, right? It's a loss leader. So keep in mind, they wear you in so that they try to get other business from you. That's where they make most of the money. So I hope I answered most of your questions. All right. Do you see anything in the near future that's going to affect any of this? Is the variable rate and the mortgage going to change? I highly doubt it, because they haven't moved really the prime lending rate, and it's going to take a significant drop in the economy for the Bank of Canada to adjust that number to make it lower, because really, if they do lower that number, it's going to affect investors' money, pension fund managers, and all that. All the pensions is revolve around how much money they can make, right? And if they're going to lend out at that low of a bond rate and the bond yield, they're not going to make enough money to keep above inflation. And as it's sort of like, you got to weigh the benefits as an investor of those guys to invest money into the mortgages, right? Bond rate, if it drops, maybe. All right. And any further, I'm not an economist, and I don't know what the Bank of Canada is going to do, but I really highly doubt that they're going to move much further, right? Either down or up. Up, less likely. Down, who knows? They may just hold it and keep it status quo for now, right? So hopefully I answered all your questions. And if you have any other complicated scenarios, feel free to send to me. I have a great analysis program that can help you with that. If you want to leverage in the future for finance other property, now might be a good time, because banks want to lend money. All right, they literally pushing us every day to say, hey, you have anybody that needs money? We'll help you give you a loan. We'll give you the money. Yes, the qualifying is still of an issue, right? But they're more inclined to look at it now, and they have more manpower to look at all these deals, because a lot of them are not getting approved. So that means the underwriting is sitting there and saying, hey man, I need some business, otherwise I'll be out of the job soon, right? So you have any financing requests, your friends, family, feel free to reach out to me, sua@sharingbanksecrets.com, SUA@sharingbanksecrets.com. Take care, have yourself a great day.